Well, let's focus on our first corporate after market open. Rategain Travel is the company that we're focusing on. Strong performance in the fourth quarter, great numbers for FY24 over 23. They're guiding for about a 20% organic growth in FY25 as well. We have Bhanu Chopra, Chairman and Managing Director at Rategain, who's joining us now. Bhanu, good morning. Great to have you with us here on the program. Thanks very much for your time. Prashant this side. I want to just talk about that guidance that you put out. 20% organic growth in FY25. I think there is an inorganic opportunity as well around the corner. So I want to start with that. So what is the inorganic growth going to look like? Total growth going to look like?
So good morning, Prashant. So as you're already aware, we are an acquisitive company and M&A is a big part of our strategy. Over the last 12 months, we've actually made out offers to 12 companies. And unfortunately, there has been a valuation mismatch as a result of which we haven't been able to consummate anything. And as you know, we are fiscally very, very disciplined in what we pay. So what we usually do is look at the company and see what it's going to look like in our hands. So we build out our own internal models and look for an IR north of 20% and a payback of 5 to 7 years. So given that, we've been quite disciplined on what we are willing to pay, and I'm hoping something will fructify in the next quarter or two. So yeah, we are very close and we're looking at opportunities in DaaS, MarTech, and distribution, which are the three business lines that we have.
Bhanu, that's 12 companies you made an offer, but valuations are not matching, right? So you got to be, you got about 1,100 crores of cash on the book. So you're ready. Just give us a sense. You gave us some criteria about IR and payback, etc. What geography? What's the typical sweet spot in terms of a deal size? And you'll have some sense of what the total growth could look like post this acquisition, because it looks like it will happen this quarter or the next quarter. Go on.
So, in terms of our sweet spot, we've, in terms of what we pay is about 20 million, but those are the kind of deals that we've done in the past. But looking at all the deals that we are looking at, they're actually, in different revenue ranges. Some are even very, very transformative. So it's hard to, commit to something at this point. As soon as we are closer, I'll come back on your channel and talk more about it.
But it looks like it's more than 20 million, what you're looking at this time. It's a bigger one.
You're very good, Prashant, at getting something out of me. But I'll stay firm and say we'll come back and talk about it, once we are closer.
Okay. What was the organic growth that you saw in FY24?
So we were north of 30%. Okay. And as you saw in the last quarter, that's completely organic. We did 40%.
So you're saying north of 30% in all of FY24, and you have guided for a 20% growth in FY25, correct? Just trying to get that number out of the way.
That's correct.
Okay. And on the margin front, there was a sharp jump that you saw quarter on quarter and year on year. Can you tell us what are the margin levers that you have in FY25, and how will you achieve your margin guidance of 100 to 200 basis points expansion in FY25?
So as you know, Sonia, the SaaS model is a very superior business model, and the operating leverage begins to kick in. We are operating at gross margins of north of 75%. So as we add more revenue, a lot of that flows down to our bottom line. So basically, as we scale, we should continue to see operating leverage, and we should continue to see the operating margin go up. In fact, a lot of our mature products, are north of 30%. I usually categorize our investments into three buckets. I call it babies, teenagers, and adults. Adults are like our cash cows, which I said are 30%. Teenagers are like products which are breaking even, have had some scale. but are at a tipping point to really scale up. And babies are investments, so we continue to produce their tech company. We continue to produce babies, and we invest in new products that we see have an opportunity within our customer base. And so on a blended basis, that's how we arrive at 20%. But at scale, I'm pretty confident that we'd be operating at a much, much higher margins, more equivalent to where our adult products are, which is, north of 30%.
Hi, Bhanu. Good morning and good to see you. And I recall when you were talking to us about inorganic growth a few quarters ago, you were talking about marriage and how, things shape up post-marriage. Now you're talking about babies and how, you nurture them as well. So interesting times out there. Bhanu, a couple of questions on this top-line growth that you're guiding for. 20%, are you being a little bit conservative? I recall last year you had guided for a number, and by the end of it, you achieved way more than that. Now you have that inorganic growth as well that's in your fold. So do you think you're being conservative on this 20% and there's a probability that you increase it as the year progresses? That's point number one. And point number two is, you've been talking about doubling your revenues on FY24 base. So you'll be a 2,000 crore company by FY26-27?
That is correct. So in terms of addressing your first question on being conservative, so look, if you look at last year, we guided for 55 to 57% on top line growth, and we ended at 69% for the year. We guided for 17 to 18% EBITDA margin. We ended at 20%. So if you want to pick cues from that and call me conservative, I'll let you decide that. But we, want to continue to build the trust of the market and, continue to over deliver. In terms of inorganic growth, like I said, we're hard at it. But at the same time, we want to make sure that we make prudent decisions, because I believe the company has a huge potential in front of us. Ultimately, it's a marathon, and we want to build this into $1 billion revenue company. So, but we want to continue to take the right steps and be very, very prudent about what steps we do.
All right. So that 20%, there's a possibility that you upscale that, right?
Yeah, I'll continue to reinforce. We will, we're guiding for 20%, but
okay.
Yeah, I'm fairly confident that we will consummate something here, and as soon as we do, that should our growth profile as well.
All right, Bhanu, I was just looking at your verticals, and the distribution business revenue growth, that grew a little bit slower than the other models, MarTech as well as DaaS. When does it start growing in line?
So, as I've said in the earnings calls also, our business on distribution is a bit lumpy. We have, won some very, very large orders, and it took us a little while to monetize those. So the growth profile on our distribution business this year, again, should be more around the blended growth number of 20%, because we are seeing those big orders have been now monetized, and you will begin to see those numbers, play out in subsequent quarters.
Okay, I also wanted to talk about this slowdown that many IT services companies are talking about in terms of deal conversions. Are you seeing a slowdown, a deferral of deal conversions? You've actually had new contract wins which have more than doubled in FY24. How does this set you up for growth in FY25, and how are deal conversions looking now?
So in terms of deal conversions, we haven't seen any slowdown. As we focus on travel and hospitality, and our customers are doing extremely well. The attrition rates are very, very high in our industry, and as a result of which the industry has now more money because they're doing really well, and they want to move towards digitization and tech, and we are big beneficiaries of that. So as you saw in our numbers as well, we've doubled our contract wins, and we continue to see some very, very good traction this quarter as well. So nothing yet.
Bhanu, on margins, you're guiding for between 100 to 200 basis point improvement in margins, right? For F5, that's a pretty wide range. Could you talk to us about, and what are the drivers here? What's the dominant driver in that sense?
So as I mentioned, Prashant, we are at a 75% gross margin. So additional revenue largely flows to our EBITDA. Our big investment is into now sales and marketing, and we are expanding our sales and marketing teams. So as the company continues to scale up, given the high margin profile, given the SaaS business model, we will continue to see acceleration in our margin profile as well. But I do believe that there is a lot of, potential for growth. So we continue to invest in our sales and marketing capabilities, getting deeper in certain geographies. And as a result of which, we want to be conservative in how we expand on these margins as well.
All right, final question, Bhanu, before we let you go. North America contributes, I think, 50-55% of revenues. There was a degrowth on a sequential basis out there. Why is that?
So one of our business lines, which is MarTech, it's sort of seasonal in nature, especially around the acquisition that we did in Adara. So what you will find is Q1 is usually stronger than Q4, and Q3 is stronger than Q2. So it was a result of that seasonality that we saw some weakness.
Okay. Since you spoke about Adara, how high are the M&A valuations now versus what you paid for Adara? If you can just give us a sense.
Well, the market has been pretty buoyant, and given the interest rates are sustaining at the levels that they are sustaining, I do believe that there will be a little bit of a letdown on the ask by some of our target companies. And that's why we are holding steady on the kind of, valuations that we are willing to pay. So, we are very clear on what we would pay, and, we want to achieve the IRR and the payback thresholds that we have. So we'll continue to remain quite disciplined about, the kind of deals that we do.
Okay, all right. Bhanu, thanks a lot for joining in. We look forward to more marriages, bringing up of those babies and, growing the company towards that 2,000 crore and then $1 billion of revenues. Appreciate you joining in and speaking to us here on CNBC TV 18.